Welcome to the CEO Money Show. I'm Michael Yorba. Thanks for joining us. I've got Robert Mennella, president of the Fee Detective. Robert, welcome to the show.
Thank you, Mike. Thanks for having me.
All right, you're welcome, and I'm glad you're here. All right, talk to me about your experience working as a bank advisor and how it kind of opened up your eyes to hidden fees that we're all familiar with.
Right. Well, yes, I've been a financial advisor for close to 3 decades, and I've been a stockbroker. I've been in investment banking. I most recently worked as a bank advisor, and my experience working as a bank advisor kind of opened up my eyes to the world of hidden fees. Not necessarily hidden as you might think, where it's in a nefarious way. They're just kind of like hidden in plain sight. So you got to kind of know where to look for them. And it's very easy to not disclose these hidden fees if you don't want the customer on the other side of the table to know about them, to kind of make the sale a little bit easier. But that made me realize that there's an enormous amount of people out there that may not be aware of all of the fees they're paying, and certainly are not aware of the cumulative effect that compounding fees have on their investments over their stated time horizons.
Now, most returns, show, performance reports and, gross up the fees, but there's a lot of hidden stuff in there. Give our audience an example of some of the things that you're talking about that you've uncovered for people, and then I want to get into your opinion of what the SEC's doing in order to really help the end investor on this point.
Right. So a lot of it has to do mostly with advisory accounts. So a lot of your big banks and brokers, they'll charge an advisory fee that's a percentage of assets. And it can run anywhere from 0.5% all the way up to 3.5% in some cases. And that's the fee that's on the surface that you must disclose. The fees that are basically hidden are the underlying mutual funds and alternative investments, separately managed accounts that are inside the portfolio that have their own costs that aren't really quantified in a performance report that most people don't know about, but it does detract from the performance, especially if you're investing long-term in an IRA or a 401k, and those costs can build up pretty quickly.
They can. Now, let's bring out this SEC. You're saying they're not going far enough.
Right. So the SEC is trying to come up with a comprehensive disclosure for investors. And they're trying to satisfy the brokerage firms as well as the investors. A lot of people have come out on the advocacy side and said they don't go far enough. Basically, what that means is that I won't get into all the details of the legalese of it, but for the fee portion of it, they're basically just asking the brokerages and the banks to describe the fees, not necessarily to quantify the fees for investors. So they'll tell people, or they'll tell the banks that you have to describe the type of fees that investors will be paying on their investment accounts, but they're not necessarily telling them this is what it's going to cost you over a long period of time.
Got it. You're developing some software. Tell us about that.
Yeah, so I'm developing some software that will allow me to more or less automate my process, where an investor can upload their portfolio to the website and instantly find out what their fees, costs, and expenses will be over their stated time horizon. So they'll have to assume a rate of return, and then we'll go in there and we'll drill down on each one of their investments, pull out the fees, costs, and expenses, multiply it by the number of the years that they plan on holding it, and then give them a hard dollar figure where they'll be able to see in dollars and cents what that cost will be, as opposed to just looking at an annual fee, which will seem kind of small on the surface.
Is there a way to be able to compare fees with like products that you're going to build into this software program?
Well, we're not going to be a registered investment advisor right off the bat, so we're not going to be offering any lower cost alternatives. We're basically just going to be doing an analysis of the underlying fees, and we're going to be able to do that by using databases that come out of Morningstar, the company's websites. The ADV Part 2 is a required disclosure that the SEC requires all registered investments to have. And so we're going to be more along the lines of the analysis, and then it will be up to people whether or not they want to stay with their current advisor, if they think that they're paying the correct amount for them to keep that relationship going. And if they don't think that they're getting the value for what they're paying, then it'll be up to them to switch to a lower cost provider. There's a lot of robo advisors out there that are offering similar advice at a much lower cost.
What's the rollout on this? How do you, after you get through some of these thresholds, you've got to raise money to be able to pay the programmers, the coders to put it together. What's your business model rollout for this? Because it sounds like it's going to be in demand. People can go find out what they're invested in, come back, check it with you, and then go back and find out a comparable model depending on their, how good they feel about the performance of, because it's performance. Nobody ever whines about the fees if the performance is good. The only time you get upset about the fees is when they're not making me as much money to compensate for those costs. So I get that model together, but what's your rollout? What's your business model to go forward on this? Because it sounds like it's a good product to me.
Yeah, I've got a lot of accolades online, and people think it's something that could be in demand. So the rollout is going to look like we're basically looking for $100,000 for 10% of the company. It's going to take us about 6 to 8 weeks to develop the software program from soup to nuts, so that we can come out with a product that people can use, and then after it becomes a little bit more popular, we're going to have to scale out, and we may need to raise additional rounds of financing of anywhere from $500,000 to $5 million. A lot of similar fintech companies have come out that have quickly ramped up their business. Personal Capital is one. SigFig is another. FeeX was started by the same guy who started Waze, who sold that to Google for $1 billion. So this is definitely something that's in demand. I think that because you're seeing a lot of people moving from active investments to passive investments, there clearly is a shift. There's a paradigm shift in the way people look at the fees that they're paying and the value that they're getting from it.
Okay, good. And being that you've got background in banking, investment banking, I'm sure the back end's all taken care of, the paperwork's right, so that somebody who is maybe an institutional investor would be accepting of the package. Take a look at it.
Oh yeah, absolutely.
Good. Robert, unless there's anything else, I think we pretty well covered it. I'm going to thank you for being a guest on the show, and I hope to have you back so we can start drilling down in some of these high-level conversations we just had today.
Yeah, I'd love to get back in touch with you. There's a lot of other things we can cover. There's some charts and there's some graphs that are allow people to, quickly look at what their fees might be. It won't be customizable or personalized like I would do it myself, or we'd be able to do with the software program. But certainly there's a lot more information out there, and a successful investor is an informed investor. And once they understand what they're paying, they can decide for themselves whether or not it's worth it.
Got it. Thanks, Robert.
Thank you, Mike.
You're welcome. You've been watching CEO Money with Michael Yorba. Thanks for joining us. Like us on Facebook, follow us on Twitter, and subscribe to our YouTube channel.